Ladies and gentlemen, good day and welcome to Sundram Fasteners Q2 FY2024 earnings conference call hosted by Avendus Spark. This conference call may contain forward-looking statements about the companies which are based on belief, opinion and expectations of the company as on the date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mukesh Saraf from Avendus Spark. Thank you, and over to you, sir.
Thank you, Yusuf. Good morning, Mukesh Saraf here from Avendus Spark. Appreciate everybody logging in. I'm pleased to be hosting Sundram Fasteners on the call today. The company is represented by Mr. R. Dilip Kumar, CFO, Mr. C. Rajgopalan, Executive Vice President Marketing, and Mr. R. Ganesh, GM Finance. We'll start with brief opening remarks from Mr. Dilip and then follow it up with the Q&A. Over to you, sir.
Yeah, good morning. Welcome all to the post-results conference call. Just by way of a protocol, if there are any media person or journalists, if you want to quote me after this conference call, please do check with me before putting out any statement in the media, because the context in which I may say some of these things will be very different compared to how it appears in the media. Thank you. Now, first and foremost, happy to announce that we recorded consolidated revenues of 1,421 crores and a net profit of 133 crores for the Q2. We've also declared a dividend of 268%. If I come to the standalone financials for Q2, the revenue from operations was at 1,234 crores, as against 1,218 crores during the same period last year. The domestic sales for the quarter was at 861 crores compared to 802 crores. And we have had 7% growth in domestic coming from both from OEM segment as well as aftermarket. We have grown in line with the industry in most of the segments, be it commercial vehicles or passenger vehicles or two-wheelers, engine segment. The tractor segment has underperformed due to unseasonal rains and uneven distribution of rains. So our sales have got affected to that extent in the tractor segment. Barring that, we have recorded about 7% growth. If I look at export sales for the quarter, we have recorded 337 crores compared to 377 crores for the corresponding period. And exports have moderated, and we all know the reasons due to the ongoing strike. Though they have reached a settlement, things are improving, but the demand had got affected. And also some of the schedules for our products with our key customers, they were facing demand challenges in the market. So our exports have got affected, both in Q1 and Q2. But having said that, as always, the Q3 outlook looks better, and Q4 looks even better, quite strong. So I am quite optimistic about the coming quarters as far as exports are concerned. And the other major, the rupee has been fairly stable compared to last year. Rupee moved from 81 rupees to about 83 rupees, been hovering around these levels. So unlike last year, where rupee depreciated sharply from 75 rupees to 81 in the first half, we have not had the benefit of that in this quarter. And the gross margins have improved, and because thanks to raw material prices have softened, the gross margins, I expect the gross margins to remain at this level or even improve in the coming quarters because steel prices have softened both internationally and domestically. And there have been favorable market settlements between OEMs and steel mills. We expect that trend to continue. And coming to other variable cost elements, all of them have been stable, including the freight costs, our subcontracting, stores, tools, etc. The power costs have marginally gone up, and as you know, Tamil Nadu government, or in Tamil Nadu, the maximum demand charges get revised on an annual basis every year. So that is how it will be in the coming years as well. So once a year is reset. So contribution for us has improved from about 24.6% to about 25.5%, almost 1% improvement in contribution. Our fixed costs have largely remained stable, the employee cost being the largest component, and all other elements of fixed costs have remained fairly stable. And thanks to some of the strong performance of our subsidiaries, this has also had an impact in some of our fixed costs indirectly. The EBITDA for the quarter has increased from 193 crores to 205 crores, and with almost a 1% increase in EBITDA margins from 15.6% to 16.5%. The finance cost for the quarter, and after taking into account exchange differences, was at 3.9 crores compared to 4.3 crores for the corresponding period. I'm happy to report that the company has a strong balance sheet, and debt-equity ratio is at 0.11, it's at a historical high. The PBT for the quarter came at 158 crores as against 148 crores, and the net profit at 118 crores compared to 111 crores. The consolidated financials for the quarter, like I said earlier, was 1,421 crores as against 1,401 crores for the quarter. And the PBT, the net profit was at 133 compared to 116. Now, if I look at the half year standalone, the revenue from operations was at 2,450 crores compared to 2,457 crores, with a profit after tax at 230 crores compared to 41 crores during the previous period. And as sales, improve in the Q3 and Q4, we hope to improve that number and surpass last year's profit after tax. The consolidated financials for the year, of the half year, was at 2,832 crores as against 2,811 crores, with profit after tax at 262 crores compared to 250 crores. Like I mentioned, two of our overseas subsidiaries, both Chinese subsidiary and UK subsidiary, have done very well for us, and it is reflecting in the sales numbers as well as in the overall profits of the subsidiaries. Now, like I said, the RM prices are stable, and we expect EBITDA to improve going forward. And the freight prices have dropped substantially compared to last year. The power has only increased marginally. The fixed costs are under control. And our depreciation charge is in line with our capital expenditure, and we are set to incur about 300 to 350 crores this year. The major EV project which we had announced is on stream, is going well. The construction of expansion of our facilities for this production is happening on stream, and we are getting expenditure. And the wind energy piece, where we had done a brownfield expansion, is on course, and we expect additional revenues to come in from Q4. And we are also incurring other additional expenditure for expansion of two-piece nuts and for export customers. So we expect the margin expansion to happen in the coming quarters. But as of this year, I don't see any significant change in our product mix. It's likely to continue as in last year. But going forward, we will see more of, from segment perspective, more of export revenues and more of non-auto, such as wind energy, accounting for a major portion of our revenues. So the coming quarters we are quite optimistic, especially Q4. And with this, I will close my opening remarks. We are happy to take the questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is from the line of Prateek Banta from Girit Capital. Please go ahead.
Yeah, this is Dhaval Shah this side. Good morning, sir.
Good morning.
So a couple of questions from my side. So first thing on the wind project side, the brownfield expansion. In the last Concall, you mentioned that by Q3 we should start seeing the revenues flowing in. Is there some delay because this you just mentioned about Q4 for the starting of the project? That's one. And second question is for the current the reported quarter revenue. We were expecting a bit better revenue compared to what you reported. And you mentioned you have grown in line with the industry in PVCV, but could you quantify, because overall PVCV industry has grown better than the growth rate of our top line. So some clarity on there. And yeah, these are my two questions, and then I'll have a third one after this. Yeah.
Yeah. So as far as wind energy is concerned, the expansion is on course, and we had mentioned Q3 and the optimum utilization of the capacity, the full revenue. We expect that to happen in Q4, but in Q3 onwards, we will see incremental revenues flowing into our P&L, and the benefit of the expansion we will see in Q4. So that was, just to clarify, that was the position. As far as the growth in the industry and your expectation and of how the industry has performed, in line with that, how we have performed, I will request our marketing head, Mr. Rajagopalan, to take the question.
Good morning.
Good morning.
All. And as Mr. Dilip said, the domestic industry has grown. Like, each segment of the industry has grown in a different manner, like commercial vehicle, passenger vehicle, and then the engines, non-auto, and the tractor, while all the other segments have grown in the range of 7-8%. There is almost stagnant or small degrowth in the tractor segment for reasons what Mr. Dilip has already mentioned. So the weighted average of the industry, or the pack we call, is somewhere around 5 to 6%, and we are well ahead of that. Is what comes out from whatever the results we have achieved. So. But then the inventory corrections also have taken place in certain customers, key customers, some portion of the key customers, because they have overstocked, and that correction plus some kind of a very, moderate growth, what has happened, was not exactly like, it was not in line with what we expected. But nevertheless, we have crossed that, and the bottom line is now the well-stocked situation among the dealers of either the commercial vehicle and passenger vehicle is getting depleted considerably, both now and upcoming festival times, and we hope the Q3 and definitely Q4 is going to be giving us a better kind of this thing. Outlook compared to what was Q1 and Q2. So the whole year, definitely we are looking at marching past ahead of the industry. So this is what I would like to say as far as the domestic industry is concerned. Mm-hmm. Of course, I think the question is for the domestic, or if it is for export.
Yeah, even on the export front, how are the inventory levels at your customer end? And what sort of outlook would you like to share in terms of growth for next 2 quarters?
Yeah, in the case of international business, there was a big kind of container shortage, and then the container cost shot over the roof in the last year, as you all know. But then that has eased out considerably, and as Mr. Dilip mentioned, the freight costs also have come down. This is one good news. The other side of the other coin of this particular thing is that the overseas customers, there are two segments of overseas customers. One is OEMs, other one is the supply chain aggregators, supply chain management companies. So they kind of were a little cautious, and then maybe they were ordering more than what they need because of the container shortage.
Yeah.
That inventory correction, now that is eased out, now the container availability is there, but then they overbought, I would say, the supply chain management companies, who eventually give it to the original OEMs. So they are going through this inventory correction, and then the good news is that inventory correction is also kind of, I would say, have happened more or less, and then the second half, it will again get back to the normalcy. As far as the OEM is concerned, as Mr. Dilip said, of course, semiconductor shortage is not, we are not fully out of it, but then the OEMs have figured out the ways and means to overcome the shortage. But then this unfortunate, the strike happened, which has put the kind of thing, sentiments backward, and the production has dropped considerably, even on a daily basis. So these things also now, with the settlement happening now, we are looking at Q3 and Q4. Definitely Q4, we are looking at things to happen, get back on the rails.
Okay.
The international market as well.
Yeah, one of the things also, sir, is that 1/3 of our revenues come from exports.
Yes.
There, the markets had underperformed. So that is where the growth had not come on overall basis.
So we did 340 crore export this quarter. So you mean we should be at least growing 10% plus quarter on quarter over next 2 quarters, given all the negatives are behind?
Yeah, that's the broad expectation at this point out. And if not in Q3, definitely in Q4.
Q4. Oh, okay. And sir, coming on the wind side, can we expect around 30-40 crore incremental revenue in the third quarter?
Yeah, no, if not, I think that number we can see in Q4, but definitely around 15-20 crores of additional revenues coming in Q3.
Got it. Okay, thank you, sir. I'll come back in the queue.
Yeah, thank you.
Thank you. Next question is from the line of Ankit Merchant from SBI Life. Please proceed.
Yeah, hello. Thank you for the opportunity. So just carrying the questions on more from the domestic sales perspective. So tractor, as per you, would have degrown by almost 2 to 5%, and for the industry, it has grown by almost 5 to 6%. So is it in line with the industry? And for the full year, how much growth can we or degrowth can we expect in this segment?
The tractor segment is not, would remain flat at the last year level, is what the expectation is. Or marginally, it could be 1%, 2% more if things are favorable for the industry. Otherwise, we are expecting the tractor, of course, tractor had a very dream growth in the last 2-3 years, all of you know. So now I think it's kind of stabilizing around 1 million, around that level. So this year is going to be flat, is what we currently feel.
Sure, sir. And on the aftermarket front, can you give us some color? How did the aftermarket perform in Q2?
The aftermarket was also in the the entire distributor and the dealer community. Kind of the inventory correction is happening, like what I mentioned in the exports. So that is also now, I would say, is easing out a bit, and then we are expecting, of course, the festival time. What happens is sometimes the aftermarket remains a bit dull because the focus is on the other festivities and things like that. But then now with all the festivals coming over in November, I am sure this next 4 months will put us back on track. And whatever sluggishness was there in the past few months, and then some cyclone, flood, and Manipur issues. So I think it's all getting either sorted out, or people are finding out, getting reconciled and getting back to their rhythm of buying and selling. So I am sure the next 5 months are going to be making us get things back on track.
Sure, sir. And another question was related to the wind segment. So some of our peers have highlighted that wind as a segment is seeing some issues or headwinds. So are we also facing similar issues, or our order book strength continues to be there? Just trying to get more color on this segment as such.
Yeah, man. I think I would be repeating the same thing. One of our major customers is also having a major inventory correction happening this year. But, of course, it doesn't mean that it has dried up, but there is some kind of the order inflow, the surge, what we expected is not happening. But it doesn't mean that the industry is going through a problem. But the industry is probably correcting the inventory, which is good for the customers as well as for us as well, to keep the line lean and mean. And looking forward, of course, the calendar year 24, the wind customers, major customers, are projecting quite bullish. Their order books, both domestic customer as well as the international customer, is a very, very healthy order book is there. So their projections are extremely good for the year calendar year 24. So as Mr. Dilip said, and our expansion plans are also going to give revenues in a significant manner. So these two things are going to help the company look wind industry in a very, very optimistic and positive manner.
Sure, sir. And on the export front, so we had a guidance of around 180 to 190 million. So will we continue to maintain that guidance, or are we revising it downwards now?
So we will be revising it down, sir. So we were hoping, in fact, it will be much on the higher side, almost $200 million. So right now, taking into account the sluggish nature of performance of Q1 and Q2, and somewhat outlook improving in Q3 and Q4, we may not be at those levels, but maybe about 10% lower.
Sure, sir. And just one last question related to EV. So have we seen any further order inflow or order wins in the current quarter? And also, if you could highlight, when are the EV orders starting in FY25? What are the guidelines as such?
Yeah, as far as EV is concerned, there are three parts to it. The business development efforts are underway, and we may close certain wins in the coming quarters. And as far as the project is concerned, it is on stream, like I said in my opening remarks, and the commercial production is slated to start in next financial year, H2 of next financial year.
Okay. And on the order wins, our order book is still at nearly about 4,000 crores?
Yes. That has not changed.
Sure. Okay, sir. Thank you. Thank you so much.
Thank you. Next question is from the line of Prolin from Goldfish Capital. Please go ahead.
Yeah. Hi, Dilip ji. I hope I'm audible.
Yes, sir.
Yeah. So a couple of questions, right? I mean, if I look at your standalone as well as consolidated numbers, from June 22 quarter onwards, our top line has been in the range of 1,400 crores, right? Or thereabout, or 1,450 crores for around 6 quarters now. Same is the case with for standalone numbers as well, where our top line has been in the range of 1,200 odd crores. And if I go back further, right, in some sense, Sundram Fasteners started as a fastener company and then they moved to other segments as well. So we have been constantly adding lots of new products to our kitty, right? And I'm talking about the core business. For the time being, let's exclude the wind and EV bars out of this discussion. So is it fair that we should be comparing our growth to the industry growth and is there not a scope to significantly grow ahead of industry because of kind of products that we have been adding to our kitty, to our traditional customer base, right? I mean, and so how should one look at this top line number both in standalone as well as consolidated basis for the next 6 quarters, given this context, right? I mean, because this has been quite flat, to be very honest. So yeah, sir. Over to you.
So you are right about your observation, and if I take you back to 1 year even earlier, let's say FY21, we came out of pandemic, and prior to that, we were at 4,000 crores. Then all companies had a big fall in the next couple of years. So from there, we have caught up and moved to about 5,000 crores last year. And I think from our perspective, that is, a very high base. So growing at 20% or 15% on top of that year on year would be a challenge. So we have to be realistic from that perspective. But having said that, if industry grows significantly, I'm talking about the automobile industry, the OEMs, if that performance is, let us say, about, we have explained this in one-to-one chats also. If that performance is 10 or 12%, you would definitely be much higher than that. And if the two-wheeler industry, where the growth is happening very well or strongly, our presence is limited in the two-wheeler segment. So we have to see the growth X after removing the performance of two-wheelers. But in the context of the consolidated performance, the two of our overseas subsidiaries, both UK and China, have acquitted themselves very well. In UK, for instance, the demand for trucks is at an all-time high, replacement trucks, and also the connectivity, last-mile connectivity requirements, because people are doing more online shopping, and also the replacement demand. So all of that is driving the truck business, and our UK subsidiary is performing well, and we expect this momentum to grow, to continue, not only in terms of turnover, also in terms of profitability and profits. On all three parameters, it will do well. In China, the construction segment has been hampered. Things have slowed down. And but I think the automobile sector is reasonably doing well. In fact, even electric vehicles within that segment. So our foundry, which we had set up a few years back, is reaching a good degree of capacity utilization and feeding into our machining division. So we are seeing good growth, and we are also well capacitized in China for at least next 2 years. So there will not be any incremental, there will not be significant capital expenditure. So we are quite positive about both the performance of overseas subsidiaries growing at a much higher rate. And so as far as the domestic, which I already explained to you, it will be contingent upon the performance of the industry.
Sure, sir. Can I just double click on that? It will be contingent on the performance of the industry. So does it mean that the product that we have and with the customers, we are well penetrated, and beyond that point to increase our market share or in that customer or to add some new products with the same customer is going to be difficult? Is my conclusion right on that part?
No, that would not be correct. I will request CR to answer that question.
Yeah, see, we have a very, very clear scientific approach. We call it as a different kind of, we have our own methodology of analyzing. So what we try to do is we always look at the pockets where our presence is not very strong. Like we are almost the single source or the large supplier to many customers. And we also find certain pockets where there is a scope to improve, there is a headroom. So those kind of areas we work, and we had special capacity in that particular area, like what Mr. Dilip said in his opening remark, two-piece nuts, assembly wheel nuts. So where we find that there is an opportunity to grow. So the improving the market share, like what you mentioned exactly, we are working on that. We are adding capacities. Though those products are already available, we are supplying, let us say, X. We try to make it 1.5X or 2X kind of a thing. That would give aid us into exceeding the customer growth projections. And also we are constantly working with localization efforts of the various customers. And the government's recent, notification on the quality control order has also kind of made the OEMs look at localizing some of the parts which are currently being imported to do localization. Though the localization was always being pursued by us, that acceleration is happening in the real on the ground. I'm sure that all these things would help us to improve the content, like vehicle. We gauge ourselves like in every segment what is the content per vehicle kind of a thing. So the content per vehicle will definitely improve because of our looking at areas where the nook and corner where we can increase the share of business, and also the localization efforts. But of course, the localization takes its own bit of time in terms of validation and all that. But with keeping that in mind, once we start the process, eventually it will result in what you said and what you're looking at in terms of improving that the gap between our growth and the customer growth. Our growth being on the top.
Sure, sir. So I mean, is it fair to then assume that this whole 6 quarter of 1,200 crores kind of a range in domestic business, right? I mean, there, let's say the delta of our growth versus industry growth was maybe 1.2, 1.3. In the next 6 quarters, because of the things that you have mentioned, right? Localization, some of the new products that you are adding, and your focus on content per vehicle. Is it fair to assume that industry growth plus 1.4, 1.5, that kind of a number, I mean, in terms of the delta, is it fair to assume that kind of a growth for the next 6 quarters in the domestic business without adding anything from wind and the EV part?
Yeah, that would be a fair estimate.
Without putting any numerals, we are the more the merrier. We are working on that.
Yeah, because you understand my point, right? I mean, for a company with a stature of Sundaram, right? I mean, to have a stagnant top line for the last 6 quarters is something which is very difficult for us to digest, right? I mean, given we have been talking about lots of these new products that we have been adding, and our focus already on content per vehicle. So let's hope that performance improves. Right. And on the export part, sir, you mentioned that maybe you won't do $200 million. That will be cut by 10%. So somewhere close to $180 million is what you are targeting. But I would have thought that what might happen is that because of this strike, right? I mean, now that it has been ending, a lot of orders will bunch up in Q3, Q4, and the year might not be lost, right? But why is that not the case?
No, just to answer your question again on domestic, going back to that question, it would not be fair to say we have not grown. I just want to set that right. we are saying is that the growth has happened from compared to FY21 to FY22, FY23. Now, if you see last 6 quarters, as in your own example, the growth has happened in FY23 compared to FY22. Now, if you see the first 2 quarters, there again, the domestic growth of our retail and our OE business has grown by 7%. It is not that growth has not happened. It is that it has not been, let's say, 14% or 15%, but it is in line with the industry. So, that just want to...
Fair point. I take your point.
Yeah. Now, going to exports, we had said initially our business plan was $200 million, or even slightly higher. But the unexpected issues of U.S. potential recession, high interest rates, many things, and some of our customers not doing well, or the products in which we were participating, the models were not moving. So therefore the schedules were cancelled. So many things have happened there, which were beyond control. But having said that, we are not dependent on a single customer or a product. So efforts are underway, and I think these 2 quarters we have kind of moderated in export performance, but you will see much improved in outcome in Q3 and Q4.
Sure. So at least the run rate will reach to that 200 number. Is that a fair point? If not full year, at least the run rate
should come to that level in Q4 probably.
Okay. All right. And one last question from my end. You mentioned that there are a lot of EV pipeline orders that you are working with, right, in some sense. So if I understand correctly, right now your EV order book stands at somewhere close to $488 million, and this will start at the end of FY25 or early FY26. And when we look at this pipeline, is it fair to assume that maybe over a 2 to 3 period, this pipeline can double? In terms of order books, from $480 to $1 billion.
The revenue should start kicking in from H2 of next financial year.
Okay.
And in terms of 2x of the current levels, yes, there are immense possibilities. It is quite possible, yeah.
Okay. Dilipji, thanks a lot, and I'll come back in the queue with more questions. All the best.
Thank you, sir.
Thank you. Next question is from the line of Maithili Balakrishnan from Alchemy. Please go ahead.
Thank you for taking my questions. Sorry to belabor the point, but just to get an understanding of what you said, when you talked about production growth of 5 to 6% for the industry, and we are growing at 7%, are you also factoring in any pass-through which happens of raw material prices, which have, certainly deflated over this past year?
Yes, yes and no, because these things we are under the contractual obligations to pass it back to customers, definitely with respect to domestic OEMs. But there are no pass-through arrangements as far as remaining 1/3 of our business, which is our export business. And in the aftermarket, it is always price correction happens prospectively. So it also happens with a lag, and so therefore my answer is yes and no.
Got it. But if I look at the domestic production, which you mentioned was 5 to 6% growth, and our domestic sales, which has grown 7%, does that 7% have an element of deflation, without which it would have been actually perhaps a 9-10%? Is that the right way to read it?
No, I don't think so. I think the benefit of lower RM is yet to be passed on, in the sense the settlements will get reached between steel mills and OEMs. Once that needs to be given effective, it will happen. You may see some of that happening in Q3 or Q4, but it has not happened so far in Q1 and Q2.
Got it. Also wanted to check with you on the exports, because I think there are now numerous data points floating around. Your target for, say, this year, is it closer to $160 million or $180 million post this 10% cut? Because I'm not sure which base.
Between that, 160 to 180.
Got it.
At this point of time, we are optimistic. And if you had asked me this question about 3 weeks back, I would have said probably 160. But today I'm optimistic between somewhere between 160 to 180.
Got it. Also, just wanted to check with you on the EV, order book and pipeline. While there has been some talk about GM and Ford slowing down on their EV investments, and wanted to get a sense from you as is that the reason why this order book is not increasing further, or are you seeing some pullback from the customers per se?
No. The EV and the market news about slowing down of GM and Ford, they are not linked in our performance.
Could you sort of elaborate on that a little bit?
So the GM business is where we are experiencing slowdown. Is not related to our EV program, our EV products.
Okay. Is there some other EV products?
Some other, correct.
Got it. And on this, EV order book, would you be able to also help us understand if there are multiple customers here, one or two customers? Is this a very concentrated kind of an order book?
A couple of customers at this point of time.
Okay, got it. And in terms of the capex, right, just wanted to get a sense of you're spending 300 to 350 crores this year, right, on a consolidated basis?
No, this is on standalone, and we don't expect that number to change significantly. Maybe another 20-25 crores on consolidated basis.
Got it. And this would be a similar number which we should expect for next couple of years?
Yeah, correct.
Got it.
Like we said, we would spend about 1,000 crores for a 3-year period, FY23 to FY25.
Correct.
So we are pretty much on target.
Correct. But if I look at, the, say, a Sri City type of a capex which has happened, which was also substantial, we have really not seen that ramping up so far. And just wanted to get a sense of what is the status of that and that customer. And, obviously we have had some delays, but do you see that sort of changing over a period of time, or that we should sort of pass it?
I'm happy to inform you that wrapping up has already started this year. Okay. And things are going well at this point of time.
It is the same customer?
Yes, the same customer.
Same customer ramping up. And if you could help us with that, usual data points of the mix between CV, PV, etc.
With respect to the domestic market, our passenger car portfolio is about 40%, and between CV, LCV and engines, it would constitute about 35 to 40%. Tractors, we are there in between 10 to 12%, and two-wheeler sub 5%. That's the broad domestic market industry performance.
Got it. And how much is OEM versus aftermarket for us?
But in terms of domestic, because of the lower export sales, we are average at about 70%. And I think in that OEM would be somewhere between 58 to 60%, and aftermarket 10 to 12%.
Got it. And if you could also help us with the non-auto part of how much is it of sales right now? And
in non-auto, in today's context, we are at, say, 30%, and with respect to auto, we are at 70%.
Got it.
While our aspiration is to be looking at 50% over a period of time in the non-auto segment.
Got it. See, we were exploring some new segments in the non-auto piece. If you could sort of just help us understand, are there pieces where you're seeing success in terms of adding new customers or getting, RFPs, etc.?
So with respect to non-auto, our participation in the wind energy segment and our push on the industrial aftermarket and pursuing business in the tractor segment, that efforts are on, and we are seeing favorable results there.
There's no plan to go on the defense/aerospace kind of projects?
With respect to aerospace, we are already there, and we do close to about 3 million, where we are pushing with the customer. There, unlike auto, it's a long haul where we need to work with the customer. which already we are in the process of getting fair amount of approvals, and recently we have got NADCAP certification for one of our process. So that should set in a lot of visibility for Sundram in the aerospace business.
Got it. That's all from my side. Thank you very much.
Thank you. Next question is from the line of Jay Kale from Elara Capital. Please proceed.
Thanks for taking my question. My first question is regarding the opportunity of import substitution. You know, a few years back we had a lot of benefit of import substitution, especially in the passenger vehicle space, and we getting orders. How are we, placed going forward in the next 2 to 3 years? Is that largely played out, or you have more scope of that playing out in the next couple of years?
Yeah, so definitely we have quite a good localization efforts. Yeah, please go ahead.
Yeah, I mean, the localization, as I said in my previous answer to some question, it was kind of not happening in a big way, but now the customers have started looking at localization seriously from many angles, which is helping them on their cost down, which is also in line with the government's Atmanirbhar kind of a push is happening directly, indirectly during the with this QCO order and all that. Because it also makes sense with the geopolitical situation for every customer to buy locally. So all these things have really started, helping the OEMs to look at the localization, which has started. And in fact, good thing is some of the critical items also they have started localizing. Like earlier, it used to be most of non-critical items, but they have also started putting the so-called critical items in the basket in the kitty of localization. That is going to be helping us in terms of improving the top line as well as the contribution margin. So it's going to happen in the next 2 to 3 years. It will be quite exciting as far as the localization is concerned. So it takes that kind of a time to, as I said, to develop so many SKUs and then ramp up and ramp down happening and all that.
Understood. And is it more to do with your existing products gaining more share from the imports, or it is also helping you in adding new products in somewhat related items?
Right. Actually, it's not the same item. All the localizations are going to be add-ons. Actually, so they are going to be new items into the basket.
Okay.
So for customers who are getting it as the KDs and whatever they call it.
Understood. And second question, in your fasteners portfolio, could you share how much of your fasteners in a vehicle, for example, in terms of fasteners, is it 30% going to engine? And if yes, then what is the BIW and chassis component of fasteners? If you can throw some light, is it as big as 20-30%, or how should one look at the non-engine fasteners split?
Yeah. This, I think you are almost you hit the bullseye. Like I would say, when you say engine, if I say powertrain, which is engine and the transmission, engine and transmission will be close to maybe engine alone will be 30-35%. In powertrain will be around 45% like that, and then chassis items and BAW put together. I think the 50-50 you can take it in terms of volume and value.
Okay, so I just to understand correctly, so 50% powertrain, which includes engine and transmission, and balance 50% BIW, chassis, and the other segments. Is that correct?
Yeah, you are right. Then when I say transmission, if you include the wheel end kind of a situation, it will be around 50-55%, and then the chassis parts, it again depends upon the, again when you get into chassis part, the portion could be lesser in the LCVs, it would be more in the heavy commercial vehicle and multi-axle vehicles. It depends upon the variants and the model and the whether it's light commercial, whether it's medium commercial, whether it's heavy commercial. It varies. In the heavy commercial, the chassis portion could be slightly higher.
Understood. And this would be similar to exports also, or because exports, exports passenger vehicles, it would be largely similar to exports as well as domestic. I mean, this contribution.
I think whether it is domestic or export, the percentages what I talked about would remain the same almost.
Understood.
Maybe in the case of exports, the value portion of the powertrain could be slightly higher. Because those are, I would say again, getting into a little more technicalities, those are higher grade alloy material. The chassis portion could be slightly lower grade alloy material.
Understood. Within your exports, how should one think about fasteners, warm forging, cold forging, etc.? If I see your blended revenues, probably fasteners is around 30-35% of your revenues. Would that be similar if I look just at your export revenues, or it will be fasteners would be a little lower of your export revenues?
Can you repeat the question, sir?
So if I could just take your export revenue.
Fastener portion of the exports is not as high as 30%. So probably around 15%.
Fair point. Understood. Great. Thanks and all the best.
Thank you, sir.
Thank you. Next question is from the line of Mr. Mukesh Saraf. Please proceed.
Yes, sir. So just before closing the call, I just had a couple of questions. Firstly, on the EV products, I think we had started with differential gears, and now the newer orders that we have won are more for the shafts. So just trying to understand how is the product pipeline going to shape up over the next 2-3 years? Because I think in some of the earlier conversations you had mentioned that you want to finally build more and more products for the e-axle. I mean, so if you could just highlight how is the product pipeline going to shape up over the next 2-3 years for these EV-specific products?
With respect to this EV, as you mentioned, we have started off with bevel gears and pinions. We already supply radiator caps. We also make fasteners. With respect to the powertrain components, we have already started manufacturing various kinds of shafts which go into your e-axle and e-drives. And with respect to our other technologies in terms of powder metallurgy, we have already started supplying some of the components like bushers which go into the EV application. We are working on the electric water and oil pump. So that way, in terms of all the technologies where we are present, we are working on the EV side.
One more point, Mr. Mukesh, is that we may also not want to grow only the export business of EV segment alone. Our growth, which would be all-round, which would focus on all our segments. For instance, we are focusing on two-piece nut for our fasteners. We will grow our rocker arm assemblies and machined parts in our autoleg division, or our powder metal parts, or hot forging vertical. So I think even in the advanced countries, it is not that they are all going to go and buy only electric vehicles. So we wouldn't want to put all eggs in one basket. So our growth, be it domestic or export, will be all round in all our segments.
Sure. Understood, sir. I was, also trying to just figure out new components, but yes, I think I understood that.
Yeah.
Secondly, sir, any update you could give on the PLI scheme? What are your conversations with the ministry now? Looking like when can we start getting some benefits of that?
Yeah, like we said, the PLI scheme, we will not do any accrual accounting from accounting perspective. But our products are still in the testing stage, and we hope to give you some news in the coming quarters.
Okay, so but the percentage will remain the same, like you had mentioned, between 8 to 12% or so expected.
Yes, because all our targets in terms of whatever they have set out in the PLI scheme, be it the revenues or the investments, we are well ahead. And also the domestic value addition, which is one of the key criteria, is way above the requirement. So we are quite confident, but yes, it has to pass through the testing agency.
Right. Got that. And just the last question on your subsidiary business. I mean, if I look at all the subsidiaries together, while your margins have improved, revenue is still kind of flat YOY. So how is the outlook for your subsidiary businesses, sir? If you could just highlight a few top ones, your Chinese one, the UK one, and maybe Upasana. How is the business there doing?
See, with respect to UK, we see a strong pull from the customer, and it serves the truck segment. So we see a good growth with respect to the UK facility. As regards China, while predominantly we serve the construction segment, there because of the China's economy as well as the down in the real estate segment, it is expected to pick up during the next year. With respect to the foundry and the machining division where we are operating, we are seeing a strong pull from the CV and PV segment. So that should help grow the business both in China as well as UK.
Yeah, Mukesh, we are quite confident of Chinese subsidies business in 2024. We expect significant growth in the next 12 months. So
we can start expecting double-digit
of Q3 and Q4 of this year. I'm quite sanguine about the outlook for Chinese subsidy, and it will be not only grow well, but I think it is going to be highly profitable as well, given the lot of work done in the area of raw materials. We have done a lot of improvements there in terms of alternate sourcing, alternate materials, etc. The prices also have fallen. So, and our higher utilization of our foundry has helped to bring down the RMC significantly. So you will see not only a good growth, but also profitable growth.
Great, sir. Great. That's good to hear, sir. I think we are more or less done, sir, with the call. Maybe if you could give some closing remarks, and then we can end it there.
Yeah, so the first two quarters, we have already discussed the performance and the H1, and like we've discussed in the call, we are quite confident of the performance in Q3 with the export sector, especially outlook improving. And after the monsoon, we also expect the retail to do well. So on all three fronts, our three major segments, OE, retail and exports, we are quite positive about the coming quarters, and also with the wind energy segment getting boost up with all the additions we have made, the capital additions we have made in Q4, additional business coming in. We expect to finish Q3 and Q4 strongly.
Great, sir. Thank you. Thanks for the opportunity, sir. Yeah.
Thank you.
Thank you.
Thank you, sir. Thank you.
Yusuf, we can close the call.
Thank you. As there are no further questions from the participants, I now hand the conference over to the management for closing comments.
I think he just gave the comments.
Yeah, I just gave the closing comments. Thank you.
Oh, sorry. So, on behalf of Avendus Spark, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Okay. Thank you.
Thank you.